U.S. markets have had an impressive run so far this year. The S&P 500 up roughly 25% year to date. The Nasdaq about 28% of a gain. But our valuations getting a little stretched, a little high at these levels. Our guest today says you may expect the upside to be limited in these markets until the earnings can catch up. David Sekera, Chief U.S. Market Strategist with Morningstar Research, joins us. David, always great to have you upon the program.
Yeah. Oh, good to see you, Greg.
I feel like this is the big question investors have after the run we have seen in equity markets this year. Where are we at? Are we justified? What's your take on the markets?
Well, with U.S. stocks closing back in on their all-time highs, we do think valuations, as compared to a composite of those stocks that we cover, are getting to be too high at this point. So, in my opinion, I think the upside here in the short term is probably pretty limited until we see earnings, start to catch up with valuations. So, we may be a couple quarters out before that starts to happen. In fact, when I think about the dynamics in the U.S. stock market, I think the U.S. stocks really are just priced to perfection right now. I mean, even before the recent election we had here, we had a lot of tailwinds behind us. The market was already pricing in moderating inflation, expectation for declining long-term interest rates next year, ongoing easing monetary policy, not only with the Fed, but with the ECB. And then we had China kind of follow on with their own fiscal monetary stimulus. And of course, now following the US elections, pricing in a much higher probability of tax cuts, people anticipating a looser regulatory environment. So with the market right now, it's trading at about a 5% premium to composite of the fair values of those stocks that we cover in the US. That's well over 700 stocks. Now, a lot of people may say, well, 5% doesn't necessarily sound like that much. But if you look at that price to fair value composite going all the way back to 2010, less than 10% of the time have we traded at this much of a premium or more.
Okay, interesting stuff. There's a lot going on there. We're going to break it all down. When I think about earnings, we're not completely out of this current earnings season and crush, but what's your take? I mean, are companies showing us something at least solid, if not spectacular?
I'd say generally, I think third quarter earnings season has really kind of played out, as we expected at the beginning of the season. The economy has been, better than expected this past quarter. So I think it was pretty easy for companies to be able to meet or beat, expectations. So it's really all been about fourth quarter guidance. And, when you look at like the Atlanta Fed GDP now, the economy here in the US is still running above, a 2% rate. So I think management teams are very hesitant to give, any kind of dour guidance. So I'd say for the most part, things are looking pretty good for the fourth quarter. So I think with the macro dynamics, the market should be pretty stable for the rest of the year. Of course, we do have the personal consumption expenditures report next week. We'll see where that comes out. But for the most part, I think the real next big catalyst for the market isn't going to be until like February of next year, once companies start coming out with fourth quarter earnings and start giving us, their take on what they expect 2025 to bring.
All right, by February of next year, we will have a new administration in Washington, the return of former President Donald Trump, now the president-elect. A lot of economic policies have been floated on the campaign trail. What's likely to make a notable impact? We don't actually know what's going to end up being policy, but from what we know right now, what are you looking at?
Yeah, well, like anything else, we're kind of waiting to see. There's always a big difference between, what might get espoused on the campaign trail versus what actually, tries to get put in place. And we'll see kind of where the first, parts of the administration's, efforts lie. But I think everyone's, pretty confident that we'll see an extension of the 2017 Tax Cut and Job Act. The market's definitely pricing in a much higher probability now of additional tax cuts, both at the corporate business tax level as well as potentially for personal tax rates as well. I think everybody's anticipating looser regulations, lower antitrust activity. So I wouldn't be surprised. In fact, I really expect to see a pickup in mergers and acquisitions next year, specifically in the tech space. The tech space actually was pretty quiet this year. The DOJ had been, very active, trying to keep the M&A in that space down, really based on antitrust concerns that precluded a lot of deals from taking place, over the past 2 years. So a lot of those that have been on the back burner, I would expect to get pulled forward probably pretty quickly next year.
Could be a very interesting year for that space in the M&A. We start talking about a resilient U.S. economy, and the world's sort of been like, wow, the U.S. seems to keep on trucking along. We talk about pro-growth policies being anticipated with the new Trump administration. Then concerns start to creep into the market about inflation and borrowing costs. The U.S. 10-year yield, I mean, it has moved higher since the Fed embarked on its rate-cutting cycle. To my mind, it's a bit of a disconnect.
Yeah, I mean, we have seen a little bit of an increase in, inflation expectations, specifically if you look at like the 5-year forward break even rate. But for now, I think all eyes are going to be on that personal consumption expenditure report next week. That is, of course, the Fed's preferred measure of inflation. Now, earlier this month, we did see CPI that did come in a bit higher than what our economics team had expected. But from their point of view, they said they just were not overly concerned. Specifically when they dug into the numbers, they noted that housing and used auto prices were higher than what their forecasts were. Now, when they look at housing, they still expect that that's going to see a correction and that we should see inflation there come down. And both of those areas are areas that have lower weightings in the PCE. So specifically, they're looking for core PCE to be 0.2% on a month-over-month basis. So on an annualized basis, that's pretty consistent with a 2% annual rate of inflation in the core. So I'd say the takeaway here from our U.S. economics team, they still expect inflation to moderate over the course of 2025. In fact, they're looking for inflation to fall below the Fed's 2% target next year. And as far as interest rates go, yes, we did see a backup in the 10-year most recently, but we're still looking for interest rates to come down across the curve. So we're looking for the Fed to cut federal funds rate throughout 2025. And on the long-term side, our U.S. economics team is looking for the 10-year to get down to 3.6% next year.
When we talk about policy heading into the new year, and of course it is a big unknown, one of the things we heard on the campaign trail is the potential for tariffs, and we simply don't know the extent. So if we end up in a situation where this is the Trump administration's preferred tool, what could that mean for the economy, for everything we worry about?
And again, I think that is really probably the biggest wild card for 2025 in my mind. Of course, tariffs, depending on what they are and how they're utilized, could potentially be inflationary. They could hamper GDP in the short term. But of course, you also have to look and see what kind of, inflationary impact that could have on individual company earnings. Companies with strong pricing power could actually see a boost in their earnings and valuations, in that case. But of course, the devil is always in the details. What kind of tariffs are they going to be? Is it just an across the board, 10% that they've talked about? Is it going to be tariffs only on goods coming in from China? We've heard them espouse, a 60% rate. Where would that number actually come out? That remains to be seen. Would there be tariffs on goods, coming from Mexico? So a lot of things that, we still have to get a better understanding as far as what might actually get implemented versus what the rhetoric was, on the trail. And of course, even then, when they do have tariffs, we need to see, well, what goods might be excluded from those tariffs, and how would those proceeds be used? Would they use those as, the proceeds to offset other ways for consumers to try and blunt that inflation? So a lot to figure out, but for now, I'm much more of like a wait and see mode to get better clarity from our policy analyst in Washington, D.C. as far as what he's hearing.